Hey everyone, and welcome to SRT Live with me, your host, Sean Richard, with the Sean Richard Mortgage Team. Thanks so much for joining me today. And the question of the hour is, when will the volatility end? And we're going to try and dive into that answer today while we cover all of the goings on in the economic and real estate and mortgage markets. So let's go ahead and dive right in with the week in review. Last week, we got limited information. We got the Fed decision, which was really the blockbuster of the week. And for those of you not watching the news stations, the Fed elected to increase the Fed funds rate 0.25%. Now, what was interesting is really the commentary that we heard from Jerome Powell after the meeting ended at his post-meeting press conference. And Jerome Powell indicated that the crisis in the banking sector and in the credit markets would potentially could tighten the economy. Now, when the Fed increases the Fed funds rate, they're doing that to tighten credit markets, to tighten the economy. Hence, quantitative tightening, you maybe heard, or QT, is what's going on. So Jerome Powell indicated that the crisis in the banking sector may result in a tightening in the credit markets, which could do the Fed's job for them on the tightening front. Well, in Fed speak, what that means is we may have seen the last of the Fed funds rate hikes for the foreseeable future. Now, only time will tell. We've got another meeting coming up here over the next couple of months, and we've got some very important inflation reports that we're going to be watching over the next 1 to 2 months. And that's really going to be a factor in what the Fed decides to do. Jerome Powell has constantly indicated that they are going to be very data dependent. So we want to keep an eye on that. But the Fed did increase the Fed funds rate by 0.25%. For any of you tuning in for the first time, as a reminder, the Fed funds rate is your short-term overnight bank-to-bank lending rates. Therefore, it affects your short-term or unsecured products much heavier than other products. It does not have a direct influence on mortgage rates. So it's going to impact things like credit card rates. It's going to impact things like auto loan rates, lines of credit, like home equity lines of credit, things like that. So that is where you're going to see that all get impacted. And it looks like my audio, I'm going to switch my audio and see if this comes through a little bit better. Try this. Hopefully this is better. All right, let's try this. That might be better. All right. Sorry, it looked like my audio was maybe not working correctly, so thanks so much for sticking with me for a moment there. Additionally, last week, as we do every Thursday, we got the jobless claims, which is unemployment claims, broken down into initial individuals filing for unemployment for the first time and continuing individuals renewing their unemployment benefits. Now, this has been a point of contention over the past several months because unemployment has stayed quite low, historically low, as a matter of fact. And the unemployment claims have not reflected the job losses that we're hearing about in the market. We're seeing job losses mainly in the tech sector, but we've got other areas of the economy, other sectors that are still growing and adding jobs. And that's really where we're seeing the tight labor market. So initial claims, this is a week over week number. So we got 191,000 new unemployment claims. And this is quite low. We've been staying in the neighborhood of 200,000 on a weekly basis. The prior week was 192,000. So we're staying right in that lane, which has been very, very low. The expectation was right around 201,000, and we came in lower than that. Continuing claims is up at 1.694 million. This was a little bit higher than expectations of actually right in line with expectations, 1.7 million, but a little bit higher than the previous reading of 1.68 million continuing claims. So these are always going to be numbers that we're watching on a week in, week out basis, because this is helping us gauge how tight our labor market is. The reason we follow that is because part of the inflation component is wage pressured inflation. If we have significantly more jobs and job openings than available workers, then companies are competing for those workers, and that's driving wages up, which is wage pressured inflation. And that's helping prop inflation up across the economy. Now, we also got new home sales, closed contracts or sold homes on new homes, new construction. This came in, and this is an annualized pace. This came in at 640,000. This was a little bit higher than the previous reading of 633,000, but a little bit below expectations of 650,000. So this is an important category for us to watch, because this really gives us a pulse of the movement or the speed at which new homes are selling. We've seen that fluctuate or vacillate pretty dramatically from last summer, when homes were selling like hotcakes. Builders couldn't build them fast enough. I would say that we're still in a position where builders are still catching up, and we're needing more inventory to accommodate the buyers in the marketplace. Now, looking at this week, so yesterday, Tuesday, we got two house appreciation data points. We got the Case-Shiller year-over-year appreciation index, and then we got FHFA, which is the Federal Housing Finance Agency, appreciation data as well. So with Case-Shiller, this is all homes, so it's a little bit skewed, and I'll explain that here in just a moment. But Case-Shiller was actually up 2.5% year over year. Now, this was down a decent amount from the previous reading of 4.6. And listen, we expected home prices, the appreciation levels to decline. So although home prices are staying relatively stable, the amount at which they're up from last year has come down year over year. So the month over month numbers, and let me give you this from FHFA, month over month, we actually had a 0.2% or 0.2% increase month over month. This was a big shift up from the negative 0.1% last month, and then the expectation was actually a 0.6% decrease in home prices. So we've started to see a little bit of shift in what home prices are doing. Now, we're going to continue to watch this needle to see if it continues to move in that direction. But for those media sources, for those individuals out there that are expecting or talking about a housing crash, I would argue that we are far from a housing crash. There may be markets that will see a more pronounced decline than other markets, but in general, it appears though we're seeing a softening, a flattening of home prices. And as we get more demand back in the market, we're going to see those home prices start to go the other direction. We may already be starting to see that. Now, let me show you this real quick. I'm going to pull this up on the screen. Hopefully this is good size for you. So January 2023 home price appreciation. So Case-Shiller, month over month, down 0.2%. And that's seasonally adjusted. So that 0.5% down is not seasonally adjusted, is what you see there on the screen right here. Year over year, up 3.8%, not seasonally adjusted. So that means that we are still above prices from where they were this time last year. From June of 2022, the peak that we saw house prices were only down 3%. 3%. That's it. We're down 3%. Does 3% sound like a housing crash? You know, housing crash 10, 20, 30, 50%. You know, we're down 3% from the peak that we saw in June 2022. Now, the cool part about FHFA and their house price index is that they strip out homes without a mortgage. So these are really financed homes. And the important part about that is that cash sales a lot of times end up a little bit lower on the price spectrum. Usually cash buyers are negotiating a bit more of a deal in some cases. So FHFA strips those out. And so we saw a month over month increase of 0.2%. Year over year, we're still seeing a 5.3%
increase from where we were this time last year. And as you can see right here at the bottom, from the peak of June of 2022, we are only down 0.6%. Very minimal decline in home price appreciation. So I wanted to share that with you today. Really important information. If you're a real estate agent, these are great conversations to have with your clients. Feel free to steal this data from me, show that to them, really absorb the information so you can have better conversations. If you're a home buyer or maybe even a home seller out there, know that this is actually great news. Although we've seen home prices skyrocket over the last several years, home prices are remaining stable, because as a buyer, one of your big concerns is, okay, if I buy a home at this price, is the price of that home going to drop dramatically after I buy it? And I'm going to be underwater unless I stay there for a significant period of time. This information lets us know that prices are stable. We're seeing minimal declines from the peaks of last year. And as demand picks up, we're going to start to see those prices come back around and probably rise at a faster pace again. All right. So we got those two critical pieces of information this week. Now looking ahead, today we got pending home sales, and I'm going to update you guys on that next week. I don't have that data prepared for us today. Tomorrow we get the third and final reading for Q4 GDP. We also get jobless claims, as we do every single Thursday. And most importantly, on Friday, we get the Fed's favorite measure of inflation, PCE, personal consumption expenditure. That's going to be a critical one to watch. Inflation is the name of the game for the Fed right now, and we need to see inflation come down so we can see mortgage rates trickle down as well. And then Friday, we also get the University of Michigan consumer sentiment. Let's see how everybody's feeling about the economy. All right. So with that being said, what am I focused on over the course of the next week? Well, first and foremost is Friday's PCE report. The Fed is watching this like a hawk. We want to see what inflation is doing. The Fed is looking at core inflation, which means stripping out food and energy. The Fed feels that those metrics are less prone to adjustment based on their monetary policy, and they're more volatile. They have less control over them. So my bet is that we're likely going to see this inflation report mirror the CPI, Consumer Price Index report, that we got earlier in the month. But what I'm excited about is the producer price index that we received earlier this month showed a healthy decline in inflation. So I'm waiting to see next month's Consumer Price Index report to see if that inflation reduction carries through from producers to consumers. And so next month's CPI report is going to be really important to watch, and we could see some nice benefit going into that report. All right, next, we're starting to see yet another shift in the market. Demand is starting to pick back up, as it tends to do in the spring and summer buying seasons. But the biggest challenge that we're running into is inventory remains historically low. Inventory in January, 980,000 homes across the entire country. February stayed the same. We've got about 2.6 months of inventory on the market, and that is below the 4-ish months of inventory that 4 to 6 months of inventory that is deemed a healthy market. So we're still running into inventory problems, which is why as demand picks up, we're going to start to see home prices rise again. Now, as inflation declines over the next few months, I would say 3 to 6 months, we should see inflation continue to decline a little bit further. Rates will come down with that. Inflation has been the biggest driver of mortgage rates going higher, so we should see mortgage rates come down as inflation comes down, and that will drive demand back to the market. We've got a lot of home buyers and potentially home sellers that are on the sidelines right now that are waiting for those rates to come down a little bit to be able to make their move. So keep an eye out for that. We're seeing that shift in the market. The initial signs of it are out there right now. And then lastly, be prepared. Agents, for you, this means equip yourselves with the right strategies to help your clients in a competitive market. You're going to be in one sometime over the next 3 to 6 months, and you want to make sure that you've got the right partners, the right strategies to help your clients win. Don't wait until we're in the market to have those tools in your tool belt. Buyers, work to make your finances rock solid. Very, very important. Understand what the market is requiring and decide if you're able and willing to do what the market requires in order to buy. Indecision will be your biggest enemy. We saw last summer, homes were flying off the shelf in hours, not days. Now, I don't know that we're going to see that type of competitive market again, but we are going to get to a more competitive position where you've got to be prepared to the point where you can make quick, educated decisions. And for both you agents out there and buyers, that's where my team and I come in. Reach out if you have any questions or you want to take a look at how to navigate the market ahead to make sure that you're in the best position to win and have success. But gang, that's all that I have for you today. If you are watching on our Powerhouse Facebook private group, thank you so much for being an incredible part of our community. If you're checking us out on Powerhouse YouTube channel, make sure that you smack that subscribe button so that you've got up-to-date real estate, mortgage, and economic information in the palm of your hands at on demand. So again, for SRT Live, I'm your host, Sean with the Sean Richard Mortgage Team. Thanks so much for joining me. I'll see you next week.